Welcome to The Explainer. Today, we are going to decode one of the most classic, hotly debated financial dilemmas out there, and we're going to do it using pure, unadulterated math. If you've ever sat down, looked at your monthly budget, and wondered how to build real, lasting wealth, well, you are in exactly the right place. We're going to put two very different financial strategies head to head.
So picture this. Imagine you have exactly 50,000 rupees every single month to deploy for your future. And let's say you have a 20-year time horizon. Where should that money go? Should you pour it into an equity mutual fund SIP, or should you lock it in to pay off a home loan EMI? Before we actually reveal the numbers, take a second. Form a hypothesis in your head. Place your mental bets right now, because the mathematical reality at the end of these 20 years might just completely surprise you.
Okay, let's dive right into this. To make this a perfectly fair, controlled mathematical split test, we have to set up our scenarios precisely. For option 1, you're taking that 50,000 rupees and investing it into a mutual fund SIP every single month, and we're going to assume a historical average return of 12% annually. For option 2, you're taking that exact same 50,000 and putting it towards a home loan EMI carrying an interest rate of 7.5% per year. Both of these are going to run for exactly 20 years.
Which brings us to our absolute baseline. Because it's 50,000 a month over 240 months, your total out-of-pocket cost over these 2 decades is exactly 1.2 crore rupees. I really want to anchor you to that number, 1.2 crore. Whether you choose the market or you choose the property, the exact same amount of cash is leaving your bank account. The playing field is completely level.
All right, let's walk down path 1, the SIP investment. Notice the sheer scale of the wealth gain here. You consistently invest your $50,000 a month. Over 20 years, as we established, your total invested capital is 1.2 crore. But look at what happens next. Because of that 12% annual return, compounding year over year, decade over decade, the interest gained alone is an astonishing 3.8 crore dollars. That completely dwarfs your original out-of-pocket cost. It brings your total final value to roughly 5 crore. Literally, you put in 1.2 and you walk away with 5.
It's almost hard to wrap your head around, isn't it? But, this is exactly why Albert Einstein reportedly called compound interest the eighth wonder of the world. Your biggest financial advantage isn't necessarily having some massive six-figure salary. It's simply allowing compounding to do the heavy lifting for you for decades. When you give it 20 years, the math stops looking like addition and honestly starts looking like magic.
Now let's pivot. Path 2, the home loan EMI. Instead of the market, let's say you buy a house today. Using standard calculations, a 50,000 rupee monthly EMI at 7.5% interest over 20 years gets you a loan of roughly 60 lakh. You pay that EMI religiously for 2 decades, totaling your 1.2 crore outflow. Now the house is 100% yours, but we really need to look at how that money was actually distributed. Half of your outflow, 60 lakh, went to paying off the actual principal of the house. The other 60 lakh? That was completely lost to the bank as interest. You basically paid double the home's initial price tag just to own it.
Now, I can hear the objections already. You're probably sitting there thinking, yes, but wait, my house isn't going to stay at a 60 lakh valuation for 20 years. The property value is going to increase. And you know what? That is an absolutely valid point. Real estate appreciates. We cannot and should not ignore that in our calculation.
So let's factor that in. Let's assume a generous, steady 6% annual appreciation on your property. Your 60 lakh home, growing at 6% a year for 20 years, becomes worth approximately 1.92 crore. That is definitely a solid net asset. You paid in 1.2 crore total, and you now hold a physical, tangible asset worth almost 2 crore. That's not a bad outcome at all, right?
Which brings us to the climax here. The ultimate wealth showdown, SIP versus home loan.
When we put these side by side, this stark contrast in wealth creation is just undeniable. Look at the breakdown. The monthly amount, exactly the same. The duration, exactly the same. Total outflow from your pocket over 20 years is exactly the same at 1.2 crore. But jump down to that final value. The SIP wealth growth, driven by a 12% return, rockets all the way to 5 crore. The home loan, on the other hand, dragged down by 7.5% interest, even with a 6% property asset appreciation, lands at 1.92 crore. The exact same financial input resulted in 2 completely different financial universes.
And this brilliantly illustrates the true cost of not utilizing compound interest. The difference between these two strategies is a staggering 3.08 crore rupees. By choosing to pay interest to the bank instead of earning compound interest from the market, you're missing out on over 3 crore of potential wealth. And remember, that's even after accounting for the rising value of the real estate.
Strictly by the numbers, compounding beats loan interest over the long term, hands down.
But hang on. Time for an important reality check. Let's look beyond the math.
Let's just pause for a second. We've spent this entire time looking at spreadsheets, but human lives are not lived purely on spreadsheets. Does this math mean you should never ever buy a house? Absolutely not. Owning a home provides incredible, unquantifiable benefits. It gives you deep security. It roots you in a community, providing immense stability. It gives you freedom from landlords and sudden rent increases. And let's not forget the sheer emotional satisfaction of holding the keys to a place that is entirely yours. You simply cannot put a price tag on that kind of peace of mind.
So what's the actual takeaway here? Well, the numbers clearly show us that if your goal is purely wealth creation, historically, long-term equity mutual funds outpace property appreciation and loan interest. But because of those deeply emotional realities we just discussed, the smartest investors don't view this as a strict either-or scenario. They combine both approaches. They buy a home to live in for that stability and joy, but they aggressively continue their SIP investments specifically for massive wealth creation.
Ultimately, it's about building a balanced life. You have the cold, hard math, and you have the qualitative reality. That 3.08 crore difference is probably burned into our minds right now, but so is the undeniable value of a permanent roof over your head. So I want to turn this over to you. Based on the numbers we explored today, what's your strategy? Would you go all in on the SIP, take the home loan, or try to strike a balance with a combination of both? Think about it and start planning your next move today. Thanks so much for joining me on this explainer, and keep learning.